Hello, we're live. Good evening. Good afternoon. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. It's my live stream, a live stream about personal finance, investing, all the things that we hope we all we should all hope that we know. So, as a financial advisor with over 30 years of real world experience, I take what I know, I teach it to you, and hopefully we're all better for it. Just so you know, while you're watching this, it's hard to go into great detail on every little topic. But if there's something you want to know more about, or if you want to reach out, check me out, clientfirststrategy.com. Reach out. It's probably worth a 5, 10, 15-minute phone call with me. And I can do a lot of things to help you, including help you choose a retirement date, age to claim Social Security, asset allocation with regard to your investments, planning, all kinds of things that I do as a financial advisor. And you'll get all of the experience that I share here on the show for the last couple of years. You get that all just for you, for your financial well being. So, with that said, a couple of things to talk about. The big stock stories, they are Apple, Johnson and Johnson, and First Republic. They are already happening. We have big stories yet to come, like big earnings this week from Meta, from Alphabet. We get earnings from Boeing on Wednesday. A lot going on, but we need to focus on more what just happened right now, I think, because we're going to talk about personal finance. The required minimum age now is 73, starting this year in 2023. And should you use a HELOC, home equity line of credit, to pay for your child's education? We're going to talk about these things right after the intro, so please stick around. All right, thank you for joining me. We're just getting started. While you're watching, of course, if you have any questions, whether if you're watching in the live or the replay, hit me up in the comments. I love hearing from you. It's the best part about what I do. Words of wisdom, words of encouragement, your stories. I love to hear about those. So hit me up in the comments, and let's just jump to how things went today in stock market world. The Dow was up 66 points. The Nasdaq was down 35. S&P up 3.5. Gold up 9. Oil up 81 cents. And the VIX is 16 and change. That's this one over here, okay? The VIX. These are very small moves. I mean, even when I did my radio show this morning, I was talking about the pre-market and how basically the day, it was a really flat opening. Very little change. And the whole day was like that. This is about as quiet of a day as you'll ever see in the stock market. By the way, you can't invest directly into an index, but you could invest into a security that tracks or mimics an index. The big stories of the day is this: Apple declares resounding victory after decision reached an Epic Games appeal. This has been going on for a long time. Apple's services business is massive. It's just huge. It's what makes Apple Apple, and it's pure profit margin. And something to the effect that Apple does, they did last year, they did just about $80 billion in services revenue, and that means App Store, okay? So Apple did about almost $80 billion last year in services revenue. This issue with Epic Games goes to the thought or the challenge from Epic Games that Apple App Store is a monopoly. And since so many people have an iPhone, like yours truly, okay? Since so many people have the iPhone, and the only way to get any apps, whether if you're playing games or news or YouTube or Gmail, if you want the app and you have an iPhone, you have to go through Apple. Apple collects like 30% of all revenue, all monies that trade that exchange hands through the App Store. So it's just a gargantuan amount of money, and they have a lock on that business. Does that mean they have a monopoly on it? No, I suppose people could use Google Play Store and whatever Microsoft's stores, whatever that is. I don't know anyone that has a Microsoft phone. Years ago they were trying to come out with something to compete, using tiles and stuff, but they never quite got anywhere with the phone, which is really surprising. Anyway, so the Ninth Court of Appeals said no, Apple is not a monopoly. They can continue to do this. It's their sphere. It's their app world, and if you want to be in it, you have to pay. Big victory for Apple. So I think that is a huge story. I think people who are investors in Apple and overall Apple, since it's the biggest company in the S&P 500 and the NASDAQ, I think a lot of people are going to be very happy about this. Now, it doesn't speak to the fact that there'll probably be maybe an appeal or another appeal. Somebody else could challenge Apple on different grounds that it's a monopoly. However, it is a pretty big deal that Apple can continue to operate the App Store the way they've been. And this is going to be really, I think, I don't think this is the kind of thing that shoots the stock up to its old former high from late 2021. But I think it adds to the to a positive, optimistic feeling from analysts about Apple. Okay, the next big story is Johnson and Johnson. They are spinning off their healthcare products. Okay, their consumer health unit. It's going to be valued at $40 billion, and that'll help the stock a little bit. This is factored into the stock. The stock is unchanged after market trading, so I don't think it's it's a huge deal. Apple, by the way, is off 10 cents in aftermarket trading. These announcements that are coming out they're not necessarily market making now, but I think they add to the positive feeling about these particular stocks. Johnson and Johnson has been considered a blue chip for since I've been in the business, and that's 33 years. Okay, so what else? The next big news story is First Republic, and the headline is just shocking. Look at this. First Republic says deposits tumbled 40% to $104 billion. Okay, First Republic says deposits tumbled 40% to $104 billion in the quarter, down from just about $200 billion, almost $200 billion. That is massive. That's like, we knew that the banks were bad, and we knew investors were pulling, or deposit holders were taking their money out of First Republic, but it just goes to show you how close First Republic was to being out of business. And the regulators, FDIC, the Federal Reserve, Treasury, and a consortium of large banks worked very hard to make sure First Republic does not go out of business. But that's a pretty shocking number, and that just goes to show you that they lost almost half their deposits. Investors are scared. And it could have been more if you go back a little bit further. Okay, let's talk about some personal finance. The required minimum distribution is now age 73. All right, so age 73. So that's this year. So if you are turning 73 this year, this is the year you start your required minimum distribution. Somebody said to me, well, it's 72 and I have to start taking my RMD. No, you're turning 73 this year. Well, I beg you, the client's turning 72 this year. So she thinks she has to take her RMD. And I'm like, no, you don't have to take it till next year. Are you sure? I am sure. And in 2033, the RMD goes to 75. The tables that are used to calculate these figures, by the way, are going to be a little higher. So it's not like you're leaving that much more money in the portfolio to possibly grow another couple of years. Just you're still going to have to take out even a little bit more, as opposed to when the average, the age used to be 70 and a half for RMDs. And last thing I want to talk about is this. You saw this in the headline. Should you use a HELOC, a home equity line of credit, to pay for your child's college education? The short answer is no. The long answer is no for many reasons. But think of it this way. If your child is going to college, you're probably at an age where you're high 40s or older. And you're at a point now where you are in like your last and probably your biggest earnings years of your life to get you set for retirement. What you do is when you use a HELOC to pay for your kids' college, you're sacrificing your own financial security at a time in your life when you don't have the years ahead of you to make up for it. That's why they say you can invest aggressively when you're young, because you have years to make up for investing mistakes. You could take more risk. It changes as we get older. I'm certainly in that category as well. So I'm not knocking anybody. I'm just telling you how life works. I have children in high school who are looking to go to college as well. So I think we're prepared. We'll see. It's very expensive, but I'm not afraid of it. Let's move on. There's two things that can happen when you take a HELOC. First of all, a couple of things. There's a few things that can happen when you take a HELOC. Your HELOC will be left with you. You could be paying that off for years and years and years. And a $50,000 HELOC today has a payment about $550 to $600 a year, a month. That's a good chunk to add to your fixed expenses every month. So, unless you could always, people, what they do is they take out more and they just pay the HELOC back with the line of credit, with the money they took from the line of credit, which ultimately does raise the amount you're paying. So even if you just have the money in the bank, you're just giving the money back toward the HELOC, but you're paying interest on it. So obviously you don't take more out of a HELOC than you absolutely would need, when you get that home equity line of credit. The way it works is your house is appraised for a certain value. Then you take the amount you have left on your mortgage, you subtract the appraisal value from your mortgage balance. That gives you your home equity. And then what will typically happen is a mortgage company, a lender will lend maybe 50 to 75% of that equity. And when you do that, though, you're getting to a point where not only you're not paying off your house, but you're digging more into leveraging your home. You're also putting yourself into the higher possibility of financial hardship when you're older, and you're sacrificing your financial security by getting you a step closer to a possible, it could happen, foreclosure. The last thing you want to do is be foreclosed on when you're 60 years old. It's hard to come back from that. These are the things that can happen when you take a HELOC for your child's education. The child might not complete college. The child might just say, I don't want to do this anymore. Is the child going to pay you back? Probably not, because you want to do something for your child because you feel this is something you should do, or maybe you feel guilty about it and you want to help the child. However, think about it this way. Maybe your parents helped you pay for college. Maybe they didn't. But college today is a much bigger percentage of one's income. The cost of college is a much bigger percentage of the parent's income than when it was when I was a kid, when I went to college. It's a much bigger percentage of income. Part of the problem is when you have something like college, it's all the data tells you that college educated people earn more than non-college educated people. It could be because they have better opportunities. It because there's something special about people who go to college and finish it. Could be a lot of reasons. But by and large, colleges have become more expensive, and as financing has become available to help pay for college, colleges become more expensive. Whenever financing becomes available for anything, the price of that thing goes up. More financing for cars, the prices of cars go up. More financing for homes, that could happen in the last couple of years with low mortgage rates, price of houses skyrocketed. That's the way it is, because people don't shop necessarily based on price. They shop based on the maximum payment that they could afford. So if colleges just gave everybody, all the kids, 5% more financial aid, colleges would just raise their prices by 5%. So no one ever actually catches up. If you got 5% more financial aid, college price goes up by 5%. It's simple as that. It's not an exact 1-to-1 ratio, but you get the drift. More financing for anything creates higher prices. And people get caught up in the vortex, and college is so expensive now that the utility and value of a college education might not be as high as it was, let's say, 15, 20, or 30 years ago. People should look at the trades. People should look at community college as an alternative for a year or two. I'm telling you, as an employer, if somebody's fresh out of college, it's a big deal. Where did you go to college? Not so much where someone went to college, just that they finished college. But as a 55-year-old adult, none of my new clients ask me where I went to college. Certainly no one asks me what my GPA was. It never comes up. So where you're going to school is not as important so much as finishing college. But if you do take out the HELOC to pay for college, you run the risk that your child might not even finish their first year. And then they have to start somewhere else. And then you have to take in even more money to pay for the first year over again if the credits are non-matriculated, if the credits aren't earned. So the other thing is, kids get financial aid, scholarship money, and student loans to pay for college. There is no scholarship or financial aid or loans for retirement. You don't get that opportunity. The other thing is, it gets easier to pay for debt as one gets older if they took on debt when they were younger, and I'll tell you why. Because over time, when your child graduates college, they're going to get a certain amount of money that they'll make. Typically, that money will rise over time because of inflation, which automatically makes it easier to pay back debt. When you're 50 or over, the inflation works the opposite. It works against you in helping you reach your financial goals. So therefore, I don't think it's right for you to take a HELOC to pay for your child's college education. There are times when it could make sense, like as a bridge loan. So if you want to use a HELOC, but you have other properties or assets that you'll be liquidating in the next 6 months, year, 2 years, 3 years, okay, go for the HELOC because you will pay it off with your other assets that just you can't sell at the moment. But when you sell those will be used to pay down the HELOC. So there's a reason why maybe the HELOC is good now, is sort of a bridge financing. The advantage of the HELOC is you could get your money now and you could get a large sum of money right away. And it's a pretty quick approval process. There are other ways to pay for college. There's other ways that the parents could certainly take on debt, college plus loans, things like that. They all come with risks. They all come with dangers. They all come with opportunity. And that's why it's important to really educate yourself on the possibilities and potentials and see how your child buys into this stuff. You know your child best. You know if it's really worth doing this for your child. It doesn't make your child worth anything less, and it doesn't mean you love your child. It just means you kind of know, you know as a parent, if your child is really going to make good on his or her promise to go to college and complete college. And until you are 100% certain about that, I wouldn't go into HOC to pay for college. That is my lesson of the day. Thank you so much for watching. I will end this live stream now, and I'll be back tomorrow. Have a wonderful. Oh, we have someone in the comments. We have Carmine. Man, this is timely. My twins are entering college in August. Oh my God, Carmine! I congratulations. Good luck. Twins in college. Oh my God! But that's wonderful. I'm sure they are going to just be great for it, and you're in a good position, and it'll all be worth it. And good luck. And I know we're going to make a plan soon, so I'll talk to you soon. All right. Take care, guys. Thank you very much. Bye.